Hello, everyone. My name is Ken Leon, Director of Equity Research with CFRA. I would like to welcome you to today's webinar on Biopharmaceutical Industry Outlook, the impact of new balance of power in Washington, D.C. Joining me today are CFRA Healthcare Equity Analysts Colin Scarola and Kevin Wong. Now, before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we'll do our very best to answer as many of these questions as we get them. Let's take a look at today's agenda on slide 3. So over the next hour, my colleagues and I will discuss the industry trends in the U.S. pharmaceutical industry, high drug prices, with leading questions of what changes might be made to lower drug prices, and should we expect any regulatory or legislative actions. And of course, we'll also have our investment views from Colin and from Kevin with their best ideas in biotech and pharma, and then Q&A. So for some of you who are not familiar with CFRA, we'd like to cover our history and our research proposition. CFRA has been an independent research provider with over 90 years of growth. It has a long, stellar history with CFRA founded in 1994, leading to 2010 reacquiring RiskMetrics, and then also acquiring from MSCI. In 2016, October of 2016, brought the fundamental research and ETF and funds management business from S&P. So today, we're one of the world's largest independent research firms. Next slide. A very busy chart, but one where it really identifies the value creation for the CFRA advantage. CFRA's integrated solutions is a big consumer of data from the well-known providers you see on the upper part of the flywheel. We have obviously discussions with and relationships with managements, and as industry experts, we are going through analytics and data. Our expertise and capability to curate this data is really our edge, and it enables our 75+ global analysts to come up with unique investment views. It helps drive idea generation, and it leads to performance and our track record. Often we use data analytics in our platforms to do deep dives on not only companies, but also peer groups or industries. And it also gives us an ability, whether it's in forensic accounting, legal, or earnings, to talk about the outlook for companies or in some cases, industries. We have the research insight on 11 sectors and 68 industries. We cover on the fundamental side 1,500 global companies with our STARS recommendations. Moving next. So the flywheel generates our ability of having investment views and commentary on different types of published output from our equity strategy team on market commentary to sector and industry research. Again, our industry research also flows onto our platform, MarketScope Advisor, with industry surveys. ETFs and mutual fund research is another area where we're differentiated and have strong track record on performance. And the foundation of our research is company research, both on the fundamental side as well as forensic. Addition to that, we have below the qualitative research, quantitative coverage of over 25,000 plus companies. Many of our customers look to our platform for portfolio risk monitoring. We have model portfolios on the MarketScope Advisor platform. And as I mentioned before with thematic, we drive for differentiated idea generation to find opportunities for alpha and performance. Next slide. What we're really excited about with CFRA is that the entire firm, all the resources, whether they're in research, sales and marketing, technology, are all driven for one purpose, which is research. That's all we do. We are clearly independent. CFRA does not manage money or make trades. Many of our independent investment research providers claim to be free of conflicts, but they're not. So with that, let's move on to today's presentation, turning it over to Colin Scarola on the U.S. pharmaceutical industry. Good morning, Colin.
Good morning, Ken. Thank you. And as Ken mentioned, before we get into a conversation on the recent headlines around high drug prices and what's going on in Washington, we're going to do a pharmaceutical industry overview. So starting on slide 10, we'll go through some of the key competitive drivers for the industry. So there are two main phases of a drug's life cycle. There's the research and development phase before it is actually marketed and prescribed for patients. And the key thing to know about this phase is how costly and time-consuming it can be for firms that compete in the industry. Drug development cycles can cost upwards of $5 billion for some of the biggest programs, and they can take sometimes 5 to 7 years before they get marketing approval from the FDA. So to figure out how much time and money that they want to spend on R&D programs, drug firms typically assess the markets and the type of diseases and the amount of patients that are out there for the different treatments. So as we might guess, diseases that affect many people we know and are more common are usually the biggest therapeutic areas for drug companies. These are things like oncology, diabetes, and arthritis. But after the R&D phase, the drugs go out and compete in the marketplace, very similar to how other products compete. Some of the biggest things they have to worry about are drugs from competing companies. And so an example of this is Viagra and Cialis, which we've all probably seen commercials for, whether we like it or not, where there's similar drugs competing for the same indication. And beyond two brand drugs, after a certain amount of time, a brand can also see competition from generic copycat drugs, which bring in a large influx of competition and rapidly drive down prices. One other factor that can affect the pricing of brand drugs is the scale or breadth of the firm's drug portfolio. So for the larger firms, maybe like Pfizer and Johnson & Johnson are some of the biggest U.S. drug firms, because they sell so many drugs and negotiate across a wide portfolio with pharmacy benefit managers and insurance companies, they've got a little bit more leverage in those pricing negotiations. Let's move to slide 11 now, and we'll take a look at the relationship between that first phase we talked about, which is R&D spending, and then the second phase, which is when the drugs transition into the FDA approval and marketing stage. So on this chart, the number of novel drugs approved by the FDA each year is shown in orange, and the year-over-year growth in R&D spending is shown as the blue line. So one of the things we think is interesting to point out on this chart is that 2016 saw a steep drop-off in novel drug approvals. It was one of the lowest years of this economic cycle. And we think that that was related to earlier in the cycle, 2012, 2013, 2014, very low, or relatively low spending on R&D. And as we mentioned, these R&D programs take many years to develop. So we think the lag there showed where low growth in spending eventually led to a pretty down year in R&D, novel drug approvals. But similarly, a big ramp in R&D spending around 2015 and 16, we think helped approvals reach record highs in 2018. So this is certainly not an exact science, but we think there is a strong relationship between how much companies spend on R&D in early years and how that eventually impacts the number of new drugs that they get approved down the road. So moving to slide 12, we'll try to illustrate here with a chart why it's worthwhile for drug companies to spend so many years and so many billions of dollars on some of these R&D programs. So a good example is when they can have really tremendous success with a really effective drug on a large patient population. So Keytruda, made by Merck, and Opdivo, made by Bristol Myers Squibb, are two of the most successful cancer treatments right now. And they were both approved in late 2014. So we saw their combined revenues go from zero in 2014 to over $14 billion by 2018. And that's obviously tremendous growth. It's a compound annual growth rate of 110%. And just to give you some context, it took Amazon 13 years to reach the $14 billion revenue mark. And these two drugs were able to do it in just 4 years. So this is obviously a very lucrative opportunity when drug companies can find these effective drugs on a large patient population area. And as we might expect, that usually leads them to spend most of their R&D efforts in these high patient population areas. But now let's move to slide 13. And we think it's probably helpful to explain a question that might come up, which is, if the drug companies are only spending their time and money on large patient population areas, how do rare diseases get treated? So to help address that question, the FDA several decades back implemented a program called the Orphan Drug Status. And an orphan drug is essentially a drug that treats very rare conditions. The law to get orphan status requires that the number of U.S. individuals affected by the condition is less than 200,000, which works out to something like less than 7 people for every 10,000. So if you get a drug approved for a rare condition like this and you get orphan drug status, you get a pretty lucrative incentive from the FDA, which is 7 years of exclusivity on that indication. So typically you only get 5 years for a new drug. So they bump up the incentives to help the brand drug have a much longer or significantly longer life cycle, where it can be the exclusive drug treating that orphan indication. And it can also keep out generics for that 7 years as well. So what we're seeing over the last 7 or 8 years, and what's projected to continue out to 2024, is that these incentives are working very well, and orphan drug sales are expected to grow twice as fast as standard generics or standard brands. So let's go to slide 14 now, and we'll talk a little bit about why is the exclusivity, such as what you get for orphan drugs for 7 years, why is that exclusivity so important? So this chart shows the annual U.S. sales of a drug called Sustiva, which was a Bristol Myers Squibb HIV treatment. So as you can see in the chart, up until around 2014, sales were doing pretty well at over $1 billion a year. But eventually, a generic patent challenge occurred. So the patents were invalidated, and generic competitors started to enter the market for this drug. So in 2016, we saw one generic entrant, which drove down sales of the brand drug considerably. And by 2018, there were now 5 generic entrants on this brand drug. And at that point, the brand drug sales really plummeted due to breaking up its market share amongst all the generic entrants, as well as seeing price declines. So this is a big reason why the FDA tries to promote generic competition and biosimilar competition, as Kevin will touch on later, because the commensurate price decreases they feel are good for the consumers or the patients in this case. So now that we've talked a little bit about why generic entry is a threat to drug makers, let's move on to slide 15, and we'll talk about competitive drivers for the generic industry now, as opposed to brand. So a key factor for generic makers is the availability of brand drugs that they can target. So they closely monitor patent expiration dates and regulatory exclusivity rights. For example, if an orphan drug's 7-year exclusivity period is expiring, that'll start to garner a lot of interest from generic companies who want to enter the market with a copycat of the original drug. And the FDA regulates the number of competing versions of each drug. Just like you have to get a brand drug approved at the FDA, you have to do the same thing with a generic drug, only the process is abbreviated because typically you don't have to do your own multi-year clinical trials. The generic version can rely on the clinical trials of the original brand drug. So moving to slide 16, we'll take a look at the availability of brand drugs that were going off patent, as it's called, over the years. So this chart is showing an estimate of the percent of worldwide drug sales from brands that were going off patent in a given year. So what we saw recently, or relatively recently, was in 2012 and 2015, a patent cliff, where there was an unusually high percent of brand sales going off patent. And this created a target-rich environment for the generic companies because they can come in, introduce generic versions, get them approved at FDA, and really start taking market share from those valuable brands. But more recently, in 2018 and 2019, it's been a relatively calm period with a more normalized level of patent expirations. And it's actually going to be quite a favorable period in 2020, 2021, we think, with an unusually low percent of brands going off patent. But focusing on that 2012 to 2015 period, let's go to slide 17 and take a look at how that impacted the generic industry. So the blue bars on this chart here are showing the number of generic copycat drugs approved by the FDA. And we can see a steady increase occurred from 2013 all the way up to 2017. And we think a lot of that was driven by the large patent cliff we noted in 2012 to 2015. And that, for a while, helped generic profit margins, which are shown in the orange line. So up until 2015, profit margins were really rapidly rising, and the generic industry was doing quite well. But we think what happened as so much competition entered the generic industry, and you can see that with the number of approvals rapidly rising to over 840 in 2017. There was just too much competition on these drugs, and we've seen severe price deflation as a result, and eventually profit margins really fell off a cliff, especially in 2017, 2018, and now into 2019. But we did note some pullbacks from the generic industry last year, which we think may be helping to mitigate some of this competition. So now that we know a little bit about the brand and the generic industry, hopefully, let's go to slide 18, and we'll talk a little bit about the forward outlook for the drug industry. So in 2018, sales growth for the top 10 U.S. biopharmaceutical firms was about 5%. And that was a good year and relatively in line with kind of 3 to 6% growth over the last 5 years or so. But we're expecting to see a pretty big slowdown to 1% revenue growth in 2019. And we think a partial factor for that is some of the slowdown in R&D growth that we saw in 2017 and 2018. So with a bit of a slowdown in sales expected, we think that some firms might be looking to alternatives like M&A to bolster their sales growth. So let's go to slide 19, and we'll talk about M&A as well as some other options that drug companies have to achieve growth. So acquiring new drugs or doing share buybacks is often an easier path to EPS growth than high-risk, long-term R&D programs. And we've noted a considerable shift during this economic cycle in how drug companies are spending the bulk of their money. So on the chart on this slide, the blue bars represent R&D spending, and we can see in 2010 to 2014, R&D was consistently the biggest spending area for the top 10 drug firms. But in 2015, there was a big shift where acquisitions became by far the largest spending area. And in each of the last 4 years, either share buybacks or acquisitions outpaced R&D, which was a big shift from the 2010 to 2014 period. But as a result of that, we think that industry dry powder has been somewhat drawn down as cash positions have shrunk a little bit due to all the buybacks and acquisitions, and the industry's leverage, as shown in the green line, has steadily risen. So while valuations are still relatively low across the industry, we think the uptick in leverage will kind of lead to not so much a banner year like we saw in 2015, but maybe more well-positioned acquirers doing smaller acquisitions in 2020 and out years. So let's go to slide 20 now, and we'll assess who these well-positioned acquirers might be. So we've analyzed balance sheets for these drug companies to try to figure out what are some of the prerequisites for when they make acquisitions. And we've noted that they tend to do this when their cash and investments are at historically high levels and when their net debt is negative. So at the end of 2018, we noted two top 10 U.S. drug firms, Bristol Myers Squibb and Gilead Sciences, were both meeting these requirements. And in January 2019, as many of you might know, Bristol Myers announced a very large acquisition of Celgene. So that really leaves Gilead as our top pick for the best position to do another large acquisition. We expect future acquirers to focus on target companies with pipelines in very fast-growing therapeutic areas. Obviously, they want to get a lot of bang for their buck when they do these acquisitions. So let's go to slide 21, and we'll take a look at which therapeutic areas are expected to see the fastest growth over the next 5 years or so. So the chart on this slide shows the market share as of 2017 for the top therapeutic areas, and out to 2024, the projected market share, and the commensurate growth to accomplish that shift in market share is shown in the gray dots. So what stands out here is that oncology has been and is expected to continue to be by far the largest therapeutic area in terms of global drug sales. So by 2024, oncology is expected to be close to 19% of the total market share. And that's going to be achieved through 12% growth, which is pretty attractive for such a large therapeutic area. Other areas of note are anti-rheumatics and diabetes, as well as antivirals. Diabetes and anti-rheumatics. So let's go to slide 22, and we'll talk a little bit more about oncology, as that's clearly kind of the biggest game in town when it comes to drug market share. So this chart is showing companies with the top oncology sales projected for 2024. So a Swiss company called Roche is number one, but number 2 and 3 are Celgene and Bristol Myers Squibb, respectively. So with the pending combination of those two, we expect to see a new number one player in oncology drug sales. We also note on this chart that U.S. firms are pretty strongly positioned in oncology, with Johnson & Johnson, Pfizer, Merck, and AbbVie expected to see among the fastest growth rates in oncology sales. And staying on that theme of U.S. firms being well positioned, let's go to slide 23, and we'll see where U.S. firms stand in the projections for sales generated on top 50 drugs. So the Bristol Myers Celgene acquisition we've shown combined here, and they are projected to be the number one player on top 50 drugs. But some other U.S. firms are also looking pretty good for the next 5 years, including Johnson & Johnson, AbbVie, Merck, Pfizer, Amgen, all within the top 7 there. So finally, we'll go to slide 24, and we'll take a quick look at 2 of CFRA's top stock picks in the pharmaceutical industry. So as you might guess, based on our previous slides, we think that Bristol Myers Squibb is a pretty attractive company right now. They have, as we mentioned earlier, one of the fastest growing oncology drugs in Opdivo, which is often combined with another of their oncology drugs, Yervoy, for tumor treatments. And we expect strong growth of those 2 drugs to continue, as they've got a pretty healthy pipeline to expand into other cancer indications. We also think that the Celgene acquisition will be very value accretive for Bristol Myers shareholders, and that was mainly due to the very low valuation of Celgene prior to this deal, with a PE multiple of around 7 or 8 times, and Bristol Myers at around above 10 times. They were able to create a lot of value by issuing their higher valued shares to get the undervalued Celgene, in our opinion. So right away, we think we'll see EPS accretion of 30 to 40%. And we also think the firm is going to be very well positioned long term with their late stage asset pipeline close to tripling to 11 pretty valuable long-term drugs in our view. On the generic side, we like Mylan. We think that they have some of the lower leverage for a generic maker. And we also think they have a very attractive R&D pipeline, particularly in biosimilars, which are expected to grow rapidly over the next 5 to 10 years, as the FDA is really trying to encourage biosimilar development. And we think they've got a very healthy pipeline, and they're starting to see their first few biosimilars come out to target market share on some very attractive multi-billion-dollar brands. So with that, I will hand it over to Kevin to go on to the high drug prices portion of the presentation.
Thank you, Colin. Moving to slide 26. High drug prices have been a key issue for voters and legislators alike. With rising deductibles and rising premiums, it's really come into the limelight. We've also seen several high cases where it's really also brought drug pricing into people's concern. For example, there's Martin Shkreli, who raised the price of a 60-year-old medicine by 5,000%. He was subsequently sentenced to 7 years in prison for fraud. And then there's large companies like Eli Lilly who've been constantly rising prices on key drugs for people, such as insulin, over the past decade, making it hard for diabetics to get their regular medication. According to a nationally representative poll, almost 80% of U.S. adults found prescription drug prices to be unreasonable. Yet, a majority of those poll participants also said that prescription drugs developed over the past 20 years have improved the lives of American people. So we wanted to look more into what's the cost-benefit analysis here. Are the costs of rising drug prices worth it for people in the U.S.? Moving to slide 27. First, we wanted to take a look at and consider where drug prices are. To caveat this discussion, it's a bit difficult to look at drug prices on an aggregate level because there are gross prices, which are or list prices, which are what the manufacturers tell people are their price, but then usually what ends up being paid by the end consumer or the third-party payer is the net price, which is usually factors in a significant amount of discounts. It can easily be 45 to 50% discount on average for certain drugs. So the difference between net prices and list prices can make it hard to look at drug prices in an aggregate level because you don't know how much of a rebate or discount the manufacturer is giving for each drug. By one study, RX Savings Solutions, they took a look at prices of hundreds of drugs and noticed that they rose by an average of 6.3% at the beginning of 2019, suggesting that we're still seeing price increases despite political pressure. But looking at this on a net, that's on a list price basis. On a net price basis, we don't think that the same trend is happening. For example, Allergan expects to realize no net increase in prices in 2019 because of growing rebates and discounts. Similarly, Johnson & Johnson, despite a 6 to 8% increase in list prices in 2018, saw net prices decline and is expecting a flat to declining net prices in 2018 as well. So it seems like drug manufacturers aren't really benefiting that much from rising prices. Moving to slide 28, we took a look at RX spending. RX refers to prescription drug spending as a percentage of total healthcare spend. And if you look at the chart, the prescription drug spending as a percentage of total healthcare spend peaked in 2015 and has declined recently. It's expected to remain flat for the next several years. This suggests that drug spending perhaps is not the main driver of healthcare costs in the United States, and that perhaps there are other culprits to look to. Turning to slide 29, we took a look at out-of-pocket costs for patients. So out-of-pocket costs are the medical care expenses that aren't reimbursed by health insurance, so what people have to pay with their own money. And looking at the line in green, that's the out-of-pocket costs for prescription drugs. It's been roughly flat for the past decade, whereas physicians and clinic spending in blue and spending on hospitals in magenta both have been trending up for the past 2 decades, once again suggesting that drug spending may not be the largest driver of increased healthcare spending in the United States. And we suggest that we feel like that legislators may be aware of this fact. Moving to slide 30. So drug costs don't seem to be the main driver of healthcare costs in the United States, but why are drug list prices still so high? We suspect that one of the main reasons is because of the rebate system. Rebates are discounts that manufacturers typically offer to the middlemen, the pharmacy benefit managers, or the wholesalers, or the end consumer, the third-party payers like insurance companies, on their drugs. And typically these rebates can average 45 to 50% on major drugs. And this system creates perverse incentives for industry actors to keep drug prices high, at least the list price. The drug manufacturers want it high because then they can offer a larger rebate to the pharmacy benefit manager, or PBM. And PBM wants a bigger rebate so they can tell their end customer, the insurance company or the government, that, look, we've gotten you a big rebate, so we're doing our job. And we think that this has been an area of focus for the Trump administration. Other reasons that we think drug list prices are high is because the political apparatus in the United States is not sufficiently motivated to make change. For example, from 2017 through 2018, we had a united government, and by that I mean the House, the Senate, and the President were all aligned in terms of overall ideological belief. They were all Republicans. And despite all the rhetoric around addressing high healthcare costs and drug prices, we didn't actually see any significant change occur in the 2017 through 2018 period. Now, with Democrats taking control of the House after the November 2018 elections, it may be even harder to find common ground because Republicans and Democrats have typically diverged on how to address healthcare spending. We've seen some changes made in the past few years, but they've mostly been insignificant, like step therapy for Medicare Advantage, and the banning of gag order clauses between insurance firms and PBMs. Moving to slide 31. At an overall level, we think that drug list prices may change or become more transparent, but we don't expect firms to be significantly negatively impacted. We see some low probability, high impact scenarios that are going on right now, such as drug importation, so bringing drugs from Canada or something, or tying the prices of drugs in the U.S. to those of other nations. But we ultimately think that these types of proposals will end up hurting citizens in the U.S. more so than benefiting them. And we think it's unlikely to see any of these proposals pass in the near future. As such, we think that the biopharma industry is a favorable place to invest in right now because negative sentiment created recently by headlines has sort of really hurt valuation. Moving to slide 32, we wanted to focus a little more on what individual actors or groups are looking to do, starting with our president. President Trump has talked a lot about drug pricing. Starting in March 2017, one of his first tweets he mentioned shortly after he entered office, he was saying that pricing for the American people will come way down. About a year later, he tweeted that the administration would be launching, and I quote, "the most sweeping action in history to lower the price of prescription drugs for the American people," unquote. And as of May 2019, right now, we have not seen any significant action on drug pricing. So it seems that President Trump does not appear to actually be interested in lowering drug prices, or maybe Republicans are holding him back from doing so. Moving to slide 33. So now that we have Democrats in having control of the House after they won based on running on sort of a healthcare platform in November 2018, we expect there to be more legislation proposed around drug pricing and healthcare costs. Although that doesn't mean we expect to see more bills being passed, because a lot of these bills being submitted by Democrats are just meant to be symbolic to let President Trump and the Republican-controlled Senate know that these are things that they want. Based on recent bills and actions by Democrats, we expect bills and investigations in some of the following areas for the next few years. First one being bad actors in the drug industry. So we think this is going to be focusing on companies that raise the price of old drugs that people really need by exorbitant amounts. And these ones, I think it's easy to see legislation in this area because it's only going to focus on a few specific companies. Second would be lower patient out-of-pocket costs. We expect Democrats to focus on that, but there's many ways they can approach that, and drug pricing is perhaps not the best one. And then we also see proposals related to direct ways of lowering drug prices, which, as we mentioned earlier, we think will have little to no success. Moving to slide 34, some recent congressional action that's going on has been that the Senate Finance Committee has been asking executives of people, companies related to the pharmaceutical industry, such as the pharmacy benefit managers and drug manufacturers, about drug pricing. It seems like the Senate Finance Committee is trying to get a handle of what's driving the high pricing and seeing if there's anything they can do about it. So far, nothing new has really come out of the discussions, as we have the typical scapegoating where pharmaceutical companies blame PBMs and PBMs blame pharmaceuticals for high pricing. We've also seen Democrats make a lot more proposals recently around prices, as we mentioned earlier, none of which are likely to pass, such as drug importation, allowing Medicare to negotiate. However, we do see possible bipartisan interest in proposals related to biosimilar availability and things such as insulin prices. We formerly thought that rebate elimination seemed appealing as somewhere of bipartisan support, but after a recent Congressional Budget Office analysis, we think it's less likely. Moving to slide 35. So one possible legislation we see is the boosting of biosimilar availability. Biosimilars are the biologic equivalent of a generic drug. So when they're introduced, they usually make prices cheaper. And the U.S. significantly lags the EU in terms of biosimilar availability, as only 16 approved in the U.S. as of January 2019 versus 52 in the EU. And of those 16, only 7 have been marketed, which means the remaining 9 are not marketed as of January 2019. We think that the CREATES Act, which was first introduced in 2016, which has bipartisan support, could be passed into law. This would allow generic drug manufacturers to sue branded firms that refuse to sell enough samples. We think that the potential impact of this, though, is limited because there are still many obstacles that deter biosimilar manufacturers from having commercial success in the U.S. But we think this is a step in the right direction, and the FDA is also working on increasing biosimilar availability. Moving to slide 36, another possible elimination that we saw is rebate elimination. The Trump administration has made several proposals to eliminate rebates in Medicare Part D and in Medicaid. However, recently in April 2019, the Congressional Budget Office estimated that rebate elimination would increase federal spending. And on top of that, it's unclear if rebates would really truly disappear. We imagine that industry players would likely rewrite contracts and maybe find a different name or different way of calling rebates, maybe call it a chargeback, call it a delayed discount or something like that. So ultimately, we think that the rebate elimination proposal is now less likely and probably unlikely to significantly negatively impact biopharma manufacturers. That concludes our section on overall policy, and now I'm going to move into a few of our biotech recommendations. First one is Alexion Pharmaceuticals with a buy rating. Alexion develops and commercializes rare disease therapies and has a strong balance sheet and positive free cash flow. We think that this company is becoming an increasingly expert at developing and commercializing rare disease therapies, which is a valuable talent because it's often hard to find the patients, populations to treat for rare diseases. The company has several new things coming out, such as it's recently launched Ultomiris for paroxysmal nocturnal hemoglobinuria, and also it's expected to launch Soliris for relapsing neuromyelitis optica in the second half of 2019. Another firm that we like is Regeneron Pharmaceuticals. This company has traditionally generated most of its revenues from Eylea, but we see strength in its pipeline. It recently launched sales of drug Dupixent for moderate to severe asthma and also Libtayo for squamous cell skin cancer. We think that the company has a strong net cash position as of March 2019 and also positive trailing 12-month free cash flow. These factors we think are important, especially considering that we appear to be in the late stage of the economic cycle. And we think that a company that has a strong balance sheet and positive free cash flow position is more likely to make it through any sort of difficult economic circumstances. Turning to slide 38, our last recommendation in the biotech industry is Biosimilar Pharmaceutical. This company first became profitable in 2017 and now has 6 commercially available products and 3 late-stage pipeline assets. This company, like Alexion, is becoming increasingly proficient at commercializing and developing rare disease treatments. We also like their strategy and approach to developing their pipeline. And they also achieved, in their first year of sales, positive operating cash flow in 2018 and had sufficient balance sheet and cash flow position to advance its pipeline for the next few years. So that concludes my recommendations, and now hand it back over to Ken.
Thanks, Kevin. And Kevin and Colin, great job on running through the industry and drug prices. As a reminder for those on, that you can still submit questions by going to the GoToWebinar panel. We do have a few questions here. Colin, one of the first relates to generic competition. And are there certain types of branded drugs that are less susceptible to this dynamic over years?
Thanks, Ken. Yeah, that's a good question. And I think the best way to answer it is with an example. So there are generally 2 types of drugs. There's what's called small molecules, which are, things we're all probably familiar with, pill form, capsules, or any kind of white or blue pill that you take orally, versus the more complex drugs that have unique types of delivery, either injection or inhalation. And those are often the biologic drugs that Kevin spent some time discussing. So those are usually much more difficult to make as well as to get regulatory approvals for. So what we've generally seen is that the small molecule drugs, which are easier to manufacture, they're much more susceptible to competition influx and rapid price declines when generic competition does come into the market. Whereas the biologics or the more complex delivery type drugs, they're harder for generic companies to replicate, and therefore when a generic competitor does come in, the price declines are usually a little bit less severe, because you usually only will see 1 to 3 generic entrants over the first couple of years, whereas a small molecule drug you could usually see over 10 in the first couple of years. And I think a good example is Viagra, which went off patent in late 2017. That's a pill form drug that now has close to 10 competitive generics on the market. And Pfizer, the manufacturer, their sales of Viagra plummeted from several billion in previous years to less than 40 million in the most recent quarter, whereas Copaxone is a complex multiple sclerosis drug that's injected, and that went off patent. That's made by Teva. That went off patent in late 2017 as well, but that one still generated over 200 million in sales in the recent quarter and only has 1 or 2 generics. So the complexity of the drug creates sort of a barrier to entry, and we think that helps mitigate some of the effects of generic competition over time.
So Colin, I want to stay with you because the question came in on generics with price fixing allegations, and what is your take on that, the impact on stock prices or even M&A in the future?
So that's a good question, and it's timely because in the last 2 weeks we saw the Attorney General of Connecticut came out with an expanded lawsuit alleging that price fixing was going on in previous years in the generic industry. And there's been 20 generic manufacturers named in that case, and it spans over 100 drugs. And it seems that the lead generic maker that's kind of been accused of being sort of a ringleader is Teva, but also some companies like U.S. companies like Mylan and Endo are also named in that case. So we certainly think that's a big risk. Those types of things generally will take several years to play out before we know if there's going to be either a settlement or a full-on trial. It's certainly a large risk. It could scale into the billions of dollars depending on what kind of activities these companies are engaged in. But our general feeling is that for companies like Mylan and Endo, their valuations have gotten so low that we think that risk has been adequately discounted. So, for example, I think Mylan right now is trading around a 4 times forward PE multiple versus a historical average of 10 times. So it's close to 60% below its normal valuation. And we think that's probably more than it needs to be. We think that the company is still going to be growing its earnings over time, especially through its biosimilar pipeline, and that while there may be some pretty big legal damages assessed against it, its earnings power will be able to carry it through that.
Okay. So today's theme, Kevin, is on balance of power in Washington. So I want to move to the topic of Medicare for all and how that may affect the biopharma industry.
Hi, Ken. That's a good question. It's hard to tell how biopharma will be impacted because it really depends on how Medicare for all plays out. Right now, we see a variety of proposals from Democrats, and we think that if a single payer is created with significant negotiating power, companies could be heavily pressured. But at this point, we think that seems pretty unlikely, a true single payer system where the U.S. government really does all the negotiation for drugs. And in that scenario, though, if it did happen, we think that orphan and key drugs, such as drugs around cancer, would likely be better able to maintain pricing power, whereas drugs with a lot of competition or that have been around for a while, those drugs would probably succumb to the pressure of the single payer.
So a related topic has to do with price transparency to the public. So is this going to be driven by Congress or by the industry to help drive drug prices lower as well?
We think that Congress, a lot of legislators have been trying to increase drug price transparency. Healthcare is one of those industries where it's kind of notorious, where it's one of the only industries where you get your bill after you've gotten all your services, and you only know what you're paying afterwards. And so while price transparency, we think, sounds like a good idea on paper, it may not play out as well because, for one, recently prices for drugs will be put on TV soon for major drugs. And we think that this could just cause more confusion rather than actually enable people to better compare options because, as we mentioned earlier, the list price of a drug differs significantly from what the net price is, and the net price differs also from what the patient ultimately pays out of pocket. So it's hard to tell how it will impact things, but we don't think increasing price transparency to the public will necessarily make drug prices lower. On top of that, we think that if everyone's prices become transparent, drug manufacturers might shift their competitive strategies, and that might also have an unwanted effect. And finally, we think that the healthcare industry is also weird in that sometimes people don't make decisions based on best price. For example, if I said you could get an eye-correcting surgery for $5 and you could get it elsewhere for $1,000, you probably wouldn't get the one for $5 because you'd find that questionable.
Okay, so this one would either be for Colin or for Kevin, and this came on the emerging genomics industry. Do you, either one of you, cover any stocks in this industry, or which ones you favor? So it's an emerging area, obviously.
Yeah, I can start with a little bit of my take on that. That's a rapidly expanding field, and we think the capabilities that we'll ultimately have in applying kind of all the information stored in the human genome and our ability to harness that is still really in its infancy. So we think that's going to be a major growth driver for a long time. One key area we think is already seeing a huge benefit from that is companies that make DNA sequencing equipment, like Illumina and Thermo Fisher and others. But within the drug space, we're starting to actually see a lot of the larger names acquire companies that are focused on genomics research. And one example is in March, Pfizer acquired a company called Rebate Therapeutics, which focuses on gene therapies for rare diseases. So Pfizer's acquired 15% of that company, and with an option to acquire the rest of it over time if the milestones are achieved. So I don't know that we'll see any real needle movers in terms of gene therapy drugs in the next year, but it's certainly going to be, in my view, an increasing focus for acquisitions. And over the longer term, I think you'll start to see some pretty big blockbuster drugs grow out of that space. Okay.
Another question for you, Kevin, is just on M&A, and obviously the Bristol-Myers Celgene was a humongous merger. I think we saw one this week with Merck acquiring a private company for oncology, but what are we seeing on M&A activity recently, and what's ahead?
Ken, I can try to take that one. So the Bristol-Myers deal was also obviously humongous, like you said. But outside of that one, we've seen most of the large pharma firms doing kind of smaller bolt-on deals as opposed to massive mergers. So going down the list of like Johnson & Johnson, Pfizer, Merck, Eli Lilly, they've all done some larger acquisitions in the first quarter or the first 5 months of the year, but they've generally been under $7 billion. So they've been, compared to something like a Celgene, they've been a little bit smaller. And we think that's kind of in line with what we were seeing in terms of a little bit of the dry powder being run down for a lot of these companies over the last few years, because they've been so active in acquisitions and buybacks in the last 4 years that we think several of them don't really have the capacity for a mega deal like Celgene. But we're seeing them do these smaller deals and focusing on areas like gene therapy and some areas of like clinical stage biopharmaceuticals, and a lot of focus on oncology as well.
Okay. Kevin, this one for you on what impact to sales are patients buying drugs out of country, whether it be from last month's earnings call, something to be measured, or something talked about from the management?
Sorry, could you rephrase that? I didn't quite fully understand.
So the question was, what impact to sales or patients buying drugs out of the country?
Oh, I think that should probably be minimal. None of the drug manufacturers have really brought it up, and we think the cases where it does happen, it's probably pretty small. I think I know only one state has enabled it, Vermont, I believe, and that impact has not been noticeable. If it gets significant enough, we expect drug manufacturers, drug makers to step up their lobbying efforts regarding it, and they may already have significant lobbying efforts against it. We think that any sort of importing of drugs or tying drug prices to foreign prices is going to be unsustainable, because a lot of the reasons why the U.S. has the largest biopharmaceutical industry in the world and the most innovative drugs and the access to most drugs is because we pay for it. And if we stop paying for it by importing drugs from elsewhere, that's going to really dry up innovation for the future.
Okay, Kevin, let me stay with you because for many on the call, biosimilars is kind of a new area. And I wonder if you can elaborate on why it's so hard to kind of grow that pipeline.
Biosimilars have been hard to grow in the U.S. because it's been hard to make what's called an interchangeable biosimilar, which means that a doctor can prescribe the biosimilar and say that it will have the same effect as the original drug. But in most cases, you can't say that for biosimilars because these are much more complicated entities than typical drugs, like typical pharmaceutical drugs like aspirin, which is just a simple chemical formulation. On top of that, the U.S. market is very important to a lot of manufacturers of large branded biologic drugs, which makes them really try hard to protect it. And they protect it with things such as patent thickets, as it's called, where they will layer a lot of patents onto their existing drug and make it much harder for challenging or wannabe biosimilar manufacturers from entering the market. So it's like saying you have an original, like if you have an initial bike and then you add a bell to it, you get a patent for that bell. You add sort of a whistle to it. That's another patent. And sometimes these drug manufacturers end up stacking like 70 or 80 patents on one drug, which makes it really hard to enter the market if you're going to have to be litigating against 70 or 80 patents.
Okay. So I have one last question for each of you, which is healthcare sector has significantly underperformed the market. They have some very attractive qualities in terms of being defensive, total return vehicles. What do you think would be the catalyst to get the healthcare sector going, and where do you think the healthcare sector performance will be by year end?
I can start, Ken. I think I'm certainly no expert at predicting elections or political outcomes, but I think on the subject of what could a catalyst be to expand multiples in the healthcare sector, I think if we get to a point either late in 2019 or early in 2020 where we see a more moderate Democrat emerge from the presidential primary, I think that will alleviate a lot of the perceived risk out there that insurance companies would be completely eliminated, or that we'd see massive reforms and the competitive dynamics for the drug industry, things like that. Because there seems to be less of an appetite for a complete overhaul and an elimination of private healthcare companies from the moderate candidates. It seems to be more favored by progressives. So if we get to a point where a moderate seems like they will win, I think that would be a big catalyst. But it's hard to say when that will be, obviously, or if that will happen.
I have to agree with Colin on that. I think that's probably one of the major catalysts where the sort of elections are heading towards. Right now, there's a lot of headline risk related to Medicare for all, or there's the ACA repeal potentially going on, rebate elimination. There's a lot of discussion around regulation in the drug industry, and we think that the elections and this cycle and the campaign finance raising is causing a lot more people to be aware of it, even though we think that there are very few outcomes that are likely. We don't think there will be any sort of sea change in regulation in healthcare. So it's hard to say if this sort of fear around headline risks will go away in the next year, but we're hoping so. And it's also possible that if the general macroeconomic situation declines, that healthcare could outshine.
Right. Oh, great. So a relative performer, perhaps. So on behalf of the team at CFRA, and great job, Colin and Kevin, we'd like to thank you for joining us today. For those of you who subscribe to our MarketScope Advisor platform, you'll find many of the research notes and analysis that we covered today, or several of the industry surveys in the healthcare sector, and much more. If you are interested in learning more about MarketScope Advisor, please visit our website, www.cfraresearch.com, to request a trial. Should you have any questions, please don't hesitate to contact us at C-Services, that's C as in Charlie, Services, at CFRAResearch.com. Again, thank you for joining us and have a great day.